What if I told you the key to getting rich wasn't about timing the market or taking big risks? What if I told you that the world's most successful investor, Warren Buffett, built his empire by following just a few simple, powerful rules? It's true, and most people don't even know about them. Here's a shocking fact. In 1965, Warren Buffett took control of a company called Berkshire Hathaway. At the time, it was worth just $19 per share. Today, it's worth over $500,000 per share. That's a return of more than 2,500,000%. While most people are chasing quick wins, Buffett quietly became one of the richest people in history by sticking to a few timeless strategies. In this video, I'm going to share the exact strategies that allowed Buffett to build his fortune. You'll learn how understanding the power of time, moats, and risk can transform your investing game. Plus, you'll discover why paying attention to just a few key principles can make you richer than you ever imagined. Stick around, you won't want to miss this. Let's dive into the secrets that can change the way you invest forever. Chapter 1. The Hidden Wealth in Buy and Hold, the Ultimate Time Machine. When it comes to investing, many people want to get rich quick. But Warren Buffett, one of the wealthiest people on the planet, will tell you that the real wealth is found by simply holding onto your investments for the long haul. In fact, Buffett famously said, "Our favorite holding period is forever." The longer you hold, the more your investments can grow due to the magic of compound interest. Here's the thing. If you're constantly buying and selling, you're missing out on the true potential of your money. When you buy a great company at a fair price and hold onto it, you're not just betting on the market. You're betting on the company's ability to increase in value over time. In the stock market, patience is not just a virtue, it's a wealth-building strategy. Buffett's personal success is a result of holding for the long term. The average annual return of Berkshire Hathaway, his holding company, has been around 20% since he took control. That's more than double the S&P 500's average of around 9%. Think about it. If you invested $10,000 in Berkshire Hathaway in 1965, it would be worth over $280 million today. That's the power of time. The key is to ignore the noise. While the market might fluctuate day to day, it's the long-term growth of the companies that matter most. As Buffett puts it, time is the friend of the wonderful company, the enemy of the mediocre. This means that the better the company, the longer you can let it grow without worrying about every market dip. Buffett advises investors to look for companies that have proven themselves over time and have a predictable future. This is why companies like Coca-Cola, Apple, and American Express are some of his biggest holdings. They've not only stood the test of time, but they've also found ways to continue growing. So, instead of looking for quick profits, focus on finding companies that you can hold for decades. Chapter 2. The Power of the Moat, How to Identify Invincible Businesses. One of the most important concepts Buffett talks about is the economic moat. This refers to a company's competitive advantage, something that protects it from competitors. Imagine a castle surrounded by a deep moat. That moat keeps enemies at bay, ensuring that the castle remains safe. In business, a strong moat means that the company can defend its profits and continue growing, even when the market gets tough. Buffett says that an ideal company has a wide moat, something that gives it an edge over competitors and makes it difficult for others to enter the market. For example, Coca-Cola has a massive brand recognition moat. Its secret formula, combined with decades of brand loyalty, makes it hard for new soda companies to take significant market share away. One of the most famous examples of a strong moat is Apple. The company doesn't just sell phones or computers, it sells an ecosystem. Once you buy into the Apple world, it's hard to leave. You start with an iPhone, and soon you have a Mac, an iPad, and an Apple Watch. Apple's ability to retain customers and charge a premium for its products is a direct result of its moat. But moats aren't always obvious. Some companies have intangible assets, like intellectual property, that protect them. Others might have scale advantages. For instance, Amazon's scale allows it to offer lower prices and faster delivery times than its competitors, which acts as a huge moat. But moats aren't static. They can erode over time if a company fails to innovate. That's why Buffett focuses on businesses that not only have a moat, but one that is durable. A company's moat should be able to stand up to competition for decades. Chapter 3. Risk is not what you think. Why market volatility is your best friend. When most people think of risk in investing, they think of losing money. But Buffett has a different take on risk. In fact, he often says that risk comes from not knowing what you're doing. To him, risk isn't about short-term market drops. It's about buying businesses you don't understand or overpaying for a stock. The stock market is a roller coaster ride, and it's easy to get caught up in the ups and downs. But if you have a long-term mindset, market volatility can actually be your best friend. That's because when stock prices drop, the market often overreacts. It's during these times of panic that great companies can be purchased at a discount. Buffett's view on risk is reflected in his investment strategy. He doesn't try to predict short-term market movements. Instead, he focuses on buying quality companies that will weather the storms of market volatility. During a downturn, investors who panic might sell their stocks, but Buffett sees it as an opportunity to buy. This is what he means when he says, "Be fearful when others are greedy and greedy when others are fearful." In fact, Buffett's best investments often came during market crashes. He bought large stakes in companies like American Express and Wells Fargo during tough times when others were too scared to invest. By the time the market rebounded, those companies were thriving, and Buffett's investments soared. It's easy to be afraid of risk, especially when the market goes down. But if you understand what you're investing in and the company's fundamentals remain strong, volatility can actually create opportunities. The secret is to remain calm, stick to your strategy, and let time work its magic. By seeing volatility as a friend, not an enemy, you're able to avoid emotional decisions. Instead of panic selling, you can take advantage of the market's mispricing of assets, buying valuable companies at discounted prices. Over time, this strategy will likely lead to huge returns. If you're enjoying these tips so far, don't forget to subscribe to the channel. Stay tuned, because there are even more secrets coming up that can take your investing to the next level. Chapter 4. The 2% Rule. Why you shouldn't bet the farm on any one stock. Warren Buffett is a master of diversification, but not in the way you might think. Unlike many investors who spread their money across hundreds of stocks, Buffett focuses on fewer, more concentrated investments. One of his key strategies is never to risk too much on any one company. He follows a 2% rule, which suggests that no more than 2% of your total portfolio should be invested in a single stock. The reason behind this rule is simple. It helps limit the potential damage if a company underperforms. Even if one of your holdings goes bad, it won't cause major harm to your overall wealth. This approach keeps you from taking on excessive risk while still allowing you to make large returns on your best ideas. Buffett's success is built on concentration, not diversification. In fact, his largest holding, Apple, makes up about 40% of Berkshire Hathaway's portfolio. But that doesn't mean he's betting the farm. Instead, he invests heavily in companies he understands deeply and believes in, such as Coca-Cola, American Express, and, of course, Apple. The key takeaway here is that while diversification can reduce risk, it can also limit the upside. The challenge is finding companies that you believe will grow long-term. Buffett famously said, "Wide diversification is only required when investors do not understand what they are doing." So, while you may start with a diversified portfolio, don't be afraid to concentrate your investments as you gain confidence in your knowledge of specific companies. The 2% rule is a practical way of thinking about how to balance risk and reward. It doesn't mean you should spread yourself thin, hoping every investment will be a winner. Instead, it's about investing in a few businesses that you can fully understand and believe in, while keeping your overall risk in check. Chapter 5. The Power of Circle of Competence. Master what you know. One of the most powerful strategies Buffett uses is the concept of a circle of competence. This means investing only in businesses you truly understand. Buffett has always said, the most important thing to do if you find yourself in a hole is to stop digging. In investing, this means not venturing outside of your expertise, because doing so increases the chances of making costly mistakes. Buffett sticks to his circle of competence, companies and industries where he has knowledge, expertise, and understanding. For example, he's never ventured heavily into tech companies until Apple, because he didn't feel comfortable with that space early on. Instead, he focused on industries he knew well, like insurance, consumer goods, and banking. The idea behind the circle of competence is to minimize risk by staying within what you know. When you understand a business inside and out, you can make better decisions about its future. If you don't understand how a company works or the industry it's in, you're essentially guessing. And guessing in the stock market rarely pays off. A powerful example of this is Buffett's success with Coca-Cola. He understood the power of the brand and its ability to generate consistent profits. He didn't need to guess about the future of the beverage industry because Coca-Cola's position was clear. By sticking to his circle of competence, he made an incredibly profitable investment that's paid off for decades. The key is not to try to be an expert in everything. Instead, focus on the industries and companies that you can deeply understand. Buffett's success didn't come from investing in a wide array of businesses. It came from investing in a few that he knew inside and out. Over time, his circle of competence expanded as he learned more about different sectors, but it always started with deep knowledge. Investing within your circle of competence allows you to spot opportunities that others might miss. It's about knowing which businesses will thrive and why. So, instead of spreading yourself thin by investing in sectors you don't fully understand, focus on mastering the areas you do. Chapter 6. The Silent Killer of Stocks. Why you should fear overpaying. One of the most important lessons Buffett teaches is the danger of overpaying for a stock. It's not just about buying good companies, it's about buying them at the right price. Buffett often says, price is what you pay, value is what you get. This means that even if a company is fantastic, if you're paying too much for it, you're setting yourself up for poor returns. Buffett's strategy is all about finding undervalued stocks, those that are priced below their intrinsic value. Intrinsic value is the true worth of a company, based on its future earnings potential and growth prospects. If you buy a stock for less than its intrinsic value, you have a margin of safety. This margin of safety acts as a cushion if the company doesn't perform as expected. In contrast, overpaying for a stock means there's little room for error. Even great companies can underperform for a period, and if you overpaid for their stock, you could lose money in the process. The stock market often overreacts to news, either driving stocks too high or too low. Buffett's advice is to look for opportunities when stocks are undervalued due to market overreactions. One of the reasons Buffett was able to invest in successful companies like Coca-Cola and American Express was because he found them at prices that offered great value. For instance, when Buffett bought Coca-Cola in 1988, it was trading at a price-to-earnings ratio, P/E ratio, of just 10, far below its intrinsic value. That's a key lesson. Even the best companies can be bargains if you buy them at the right time. To avoid overpaying, Buffett advises investors to always focus on a company's fundamentals. Look at things like earnings growth, management quality, and market position. If a company is growing steadily and has a strong competitive advantage, but its stock price is lower than what it should be, that's an opportunity. Buffett also cautions against falling in love with a stock. It's easy to get attached to a popular company, but the key is to stick with the fundamentals. If you're paying too much, no matter how strong the company is, the stock won't generate the returns you hope for. If you found these tips valuable, make sure to hit the subscribe button and turn on notifications. There's a lot more to explore in the world of value investing. Let's keep this journey going and build your wealth with Warren Buffett strategies.